Is the economy softer because of the trade war, or is it because your policy is too tight? That's the Larry Kudlow view, and he said it again today.
Well, I think that you can easily look at growth abroad, so global growth is slowing, right? Trade policy has created uncertainty, and the tariffs have an impact as well. And I think those factors really account for some of the slowdown that we've seen abroad and in the manufacturing sector in the U.S. and also the export side of the U.S. economy. Now, when we're thinking about monetary policy, we're always looking forward when we're looking at, our dual mandate goals, and we're going to calibrate policy to achieve those dual mandate goals. But at the moment, our policy is accommodative, and we're going to assess the conditions going forward and recalibrate our policy if necessary, right, to make sure that we achieve and maintain those goals.
Does it bother you to take the fire from the president the way that the Federal Reserve has? I mean, he's called you all clueless. He has used that word.
I've worked at the Federal Reserve for my career. I feel privileged to be part of the Federal Reserve. I feel it's a very honorable institution. And when we go into that room and do our policy decisions, we are really focused on the dual mandate goal. The best analysis, the best information we have on the economy comes to that table. We bring it in from all parts of the country, and we do the best we can. And then we try to hold ourselves accountable for meeting those goals. And so that's how you have to approach policy in these times. There's always challenges out there, and you just have to look through it and stick to the knitting and do your job.
As you talk about that dual mandate, we've touched on inflation. We had the jobs report today. Many look at it as a Goldilocks report. You could see some good, maybe some not so good. How do you read into that, and how does it play into a potential Fed decision?
Yeah, I thought it was a pretty solid report. We expected to see some slowing in job growth as growth, overall output growth, slowed this year. We are still above the estimates of what would be needed to keep the unemployment rate constant. So to my mind, that was a pretty good report. I'm attuned to the fact that there was a little bit slowing in wage growth in that report. But again, I think we have to look overall and say that wage growth is still going to sustain consumer spending. But the focus is going to be on, can we maintain that good job growth, and can consumers continue spending? And then we work through some of the softness on the business side.
Given the flow of data we've gotten in the last couple of months, the two easing moves the Fed has made since the summer, do they still qualify as insurance cuts, or are you fighting against a worse slowdown?
Yeah. I think the decision, the decision going forward is, right, we came in expecting growth to be slowing towards trend this year. There are these headwinds out there. There are risks out there, global economy slowing down, manufacturing slowing down here. And so there are downside risks on that forecast. And it's always possible that you could have a weaker growth than what you anticipated the trend. And that's the decision, is growth going to weaken more than what we think, which is basically keeping growth at trend. So that's what the assessment's going to be going forward. And I'm going to be attuned to whether we have a more sustained labor market slowdown or consumer slowdown. And that would be, to me, the things that I'm focusing on.
You brought up risk, and Eric Rosengren points to these co-working companies, not calling out WeWork by name, but as a potential risk. Looking at commercial real estate, WeWork obviously pulling their IPO. Is this a big risk for you, or something more in the commercial real estate market that you're watching?
Yeah, I would say that when you're in a low interest rate environment, you do have to be attuned to some financial stability issues that low interest rates for a long time can engender. We have seen elevated commercial real estate pricing. We have seen elevated levels of non-financial company debt. And so you have to be watching those as you go through this cycle. Right now, I think those risks are moderate, but it's certainly something that you have to be attuned for when you're in a low interest rate environment.
You said yesterday, I believe, at Brookings that you worry about what low rates can mean for financial imbalances, asset bubbles, things like that. Does that shape the way you view what the next move by the Fed could be, at least as your vote would go? You worry about rates where they already are, and if you take them lower, what the ramifications could potentially be?
I think at this point, I don't see that as being the predominant decision-making point in that. I'm really focused right now on what's the outlook for the economy, what's the risks around that outlook, and then really gearing our policy to that. But I do think that we have to be cognizant of the fact that we could be engendering some risks where we do what's good for the economy in the shorter run, and then having a little bit problematic economy in the medium run.